Hey, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions and form your own financial conclusions and make your own financial decisions. Today is Wednesday, February 2nd, 2020, and this is Blockhead Traders Weekly. In this week's episode, I'm joined by fellow Blockhead trader Viper XL 007, and we are going to take a look at the equities market this week. Touched on crypto a little bit here and there, but it's been time to get back into the equities. We've made a couple of plays recently. We've lost a couple. We've won a couple. And so this week, we just want to visit those equities again. But before we hop to that, I want to give a shout out, link in the description below, to our Discord channel. We stream this video live every Wednesday night in our Discord. It's free to join. Hop in, say hello. Love to hear from you. Love to hear what you're trading. Love to hear what you want to learn about, and we'll make some content for you. But let's get to this week's episode, Viper, the equities market. Holy volatility, dropping day after day after day with red candles. And then so far this week, lots of green candles on a rebound. And we're not talking any 0.25% moves. We're talking good solid 1 to 2% moves in all the major indexes. It is quite crazy out there.
Which, if I might say, is the perfect time for option selling.
It absolutely is. And before we hop to some of the trades a little bit later on that you made, Viper, I want to take some time to just talk through an example of what an option trade actually is, with two traders coming to the table, exchanging a contract, an option contract. And, in the market today, there was a massive move in PayPal. PayPal basically reported earnings after the bell yesterday. It was a major disappointment, just the stock got whacked on open, just insane volume. And so I thought we'd play out a scenario here of you being long some PayPal, and I will be the insurance salesman, if you would.
What we're about to play out is exactly what all trades essentially are. When you're in the equities market, when you're doing any sort of trading, it's two parties coming to the table, and in the case of the stock market, there's an order book that sits between you. And so you both go to whoever your bookie is, but still it's two people coming to the table saying, I want to do this. And then someone going to the table and saying, I'm ready to take this or whatever. And so that's kind of the lead into where we're headed here.
Yeah. So you're going to be the guy that's excited about PayPal. Viper, let's take a look at PayPal today because it had a heck of a drop.
It sure did, and it makes me excited about PayPal in this scenario. So here's one reason why I might be excited about PayPal right now is it's been on my radar. We're in this, everybody says, it's the tech bubble popping and, things are going down. And so PayPal's been on my radar here. As we look at the chart, we're looking at the daily, and let's just kind of see where this thing's been. We're going to go back and we're like, yeah, I mean, it's coming down and I don't have anything on it right now. I want to go long on one of these tech stocks that are, more of a staple in the tech industry. I want to buy something on sale. So I'm looking at this, and I mean, the last time we were at these levels was May of 2020, and then we did the big ride up, and now we're on a ride back down. And today was just kind of icing on my decision cake, because what we can see here was those earnings came out. This candle down here at the bottom, holy schmoly, like that is just absurd volume, which says to me, again, letting volume play into my decision-making process. I mean, that is volume 10x from what the normal day's trading is. And yet still within the day, we don't have a significant move on this candle. So that means a lot of people are excited about this level that it's at. So what we see happens is we see thump we see this almost 25% drop. Intraday, it actually was over 25%, but day to close, around a little less than 25% drop. So I'm thinking it's time. We're at 132 here. I'm thinking about 130. I'm ready to go long 100 shares. So I'm gonna put that order in. I'm gonna take 100 shares long of PayPal. Now, there's always those emotions in the back of your mind of like, I don't know, is it done? I mean, it is, it's easy for me to talk about now because I'm not actually taking this trade, but it is something I would consider. But when real money's on the table and you're staring at the cliff that just happened, there's a ton of emotions swirling right now of like, I don't know, is it done? How do we know it's done? I mean, technically we never do, but there's a lot of that concern of like, it might not be done. So what's the best way that me as a long holder of these shares that I could get myself a little bit of insurance here? I could actually do that through using options on the buy side. Now, obviously we've talked a lot about selling options, but in this particular case, I'm going long 100 shares. One options contract represents 100 shares. So I'm going to say I need an insurance policy here. If this thing just continues to drop to the floor, I don't want to ride these shares super long down low. So I'm going to look at the chart one more time, and I'm going to say, what's a level that I think is reasonable for this stock to get to if it keeps dropping. And so as we look at the daily here, the daily candles, we can see we had this build up and then we had this double top before a dip and rip. And so let's go ahead and kind of throw a level line down there because that's obviously an important level. We had two strong resistance, then a big rejection, and then we just went off to the races to some pretty crazy highs up here, $311. So to me, that says that this level here is very important to the mechanics of this underlying. And that happens to be roughly $122 where that is. And so now I'm thinking, all right, my insurance policy is I like $125. I am fine taking a loss from 130 to 125. If it sticks and stays below 125, aka we lose support here at this previously achieved level, I want out. However, some of you may be thinking, well, that sounds like a stop order. Like, just put a stop at 125 and, move on with your life. But if that's too rigid. A stop means as soon as we hit this, then bam, that order is going in and I'm out. And I don't really want that because this price is moving as elasticity. We might actually go below 125. We might kind of do a little wibble wobble around 125. So what I would much rather do is get a little bit of, I don't want to say liquidity, but get a little bit of malleability in my play here. So I want to buy an option at 125. And so what that means is I have the option to give somebody those shares at $125 for the batch of 100. I can buy that with an expiration date on it. So I can say, hey, like X amount of time out. I think that's enough time that we're going to get through this and then we're off to the races. So who's out there that could possibly help me out with this insurance policy that I want to buy?
I know a guy. It's me. I am like Mr. Insurance option seller man. So I look at PayPal and I also, I'm pretty comfortable with PayPal. It's a tech stock. It's a staple, Do I want to buy the shares at $130? No, not really. Do I think it's going to get down to $125? I don't know. But if it did, that'd be a heck of a deal to buy at $125, to my opinion. So, I'm feeling like I'll put an insurance out there. I'll insure you, Viper, for your put. And so remember, a put means Viper will have the option to put 100 shares to me at the strike price. And so I'm going to come to that table as the option writer, the option seller, and I'm going to hand Viper a coupon that basically says, all right, Viper, before March, we're going to go March expiration. It's about a month out. If these shares go below $125 anytime before March, you can have the option of I'll buy them from you for $125. But I'm going to need to get paid for this coupon a little bit. And PayPal's kind of volatile here. And so this is where an option chain comes in, right? This is basically the book prices, the Kelly's Blue Book of options, if you would. And so that particular strike price on the option chain sells for about $1.30. So Viper is going to pay me $1.30 for every share that he has to basically insure that share for him to get rid of it at $125, no matter where PayPal goes. If PayPal goes to $5, Viper will have a coupon that in March he can turn in for those shares and say, hey, Sprocket, you told me you'd buy this for $125. I'm turning my coupon in. And so I am taking that insurance position, and I'm going to collect that premium from him at $1.30 for every share. So $130 to give him the comfort that he can let those shares sit out there. So what does this actually mean in the end? So I put together just a little bit of a matrix here on what the outputs are from this particular trade. I have 5 prices listed. I have way down. That's basically a 10% drop from the current price that Viper's long. A down, which is about a 5% drop. Flat means it doesn't go anywhere. Up is an up by 5%, and way up is up by 10%. And remember, Viper bought these shares for $130, and he decided to buy his insurance policy at $125 for an expiration in March, which means basically in April, those things are no good. At the end of March, that's when those shares kind of, or that coupon expires, and it becomes absolutely worthless. Just like a coupon that you get for a restaurant. Once it expires, it has no value. And Viper is going to purchase those coupons from me at $1.30 for every share, thus paying me immediately, not if he uses them or what have you, the coupon, but he pays immediately for those shares. And so I'm going to put in my pocket $130 immediately. So what happens if we go way down on PayPal? Go way down on PayPal. $117 is the PayPal share price. Viper says, okay, look, my level didn't hold. We plunge below it. I'm out. Go ahead. I want to put these shares to you, Sprocket, for $125. Pay me my $125. I'm going away. So I wrote the coupon. I am obligated to fulfill it. I cannot get out of that obligation. So I pay Viper for his shares. I buy them at $125, all 100 of them. So I spend $12,500 for those. I keep my premium. So you'll see Viper, he doesn't get his premium back, and he lost $5 a share. So he's down $630 on the trade. That's a heck of a lot better than if he'd have held on to those shares and went all the way down to $117. So he's in a good position. I mean, he's got a loss. That's not great, but it could have been worse. Me, I had to buy those shares. So now I have 100 shares of PayPal. Now I also have that $130 I collected. So I am actually long from $123.70 because I can take that premium off the share price. Now you can see I'm still underwater, but I was okay holding PayPal if I bought them at 125. That's very, very important when you go into a naked put play like this. You should be okay with the outcome of being assigned the stock. Now, let's take a look at the down situation. Same outcome for Viper. He's under $125, $124. He could sell him at $125. He's out the $130 he paid for the coupon. He loses $5 a share. He's out $630. Now, me, I again buy the shares for $12,500. I keep my $130, and I'm actually long $123.70 again. But the share price is $124. So I'm actually green on those shares because my break even or my cost basis is at $123.70. All right. Let's say it doesn't go anywhere. We stay flat. We just hang out around $130. Well, Viper, he still's got his shares. He's still long from 130. That's great. He's happy about PayPal. He's just going to keep waiting for his payday to come. However, he had to pay $130 for that coupon. That coupon is now expired. It's worthless. He effectively increased his cost basis by $1.30. So now he's actually long for $131.30 because he can't get that coupon premium back. Me, I didn't have any shares in PayPal, so I just keep the premium and the coupon is expired, so I'm under no more obligations. I got $130. Up. 5% up, same situation. Viper is out his premium of $130. His cost basis goes up to $131.30. I'm out nothing, but I keep that full $130 premium. Way up, exact same income. So you can see that as you go up and way up, Viper is actually picking up green, and he could sell for a gain, which is what his original thesis was. And so all he has done here is basically buy that insurance. So the last point I want to make here is you might think, okay, you threw out there $130, whoop-de-doo. What you need to remember is as a premium seller, I collected $130. Now, if I do this on a cash secured basis, which basically means if I do my return on capital as if I spent all those for the 100 shares, 12,500, I get about a 1% return in a month. So remember, this is 1 month out in expiration. That's a 1% return in a month. It's not amazing, but it's pretty good because that would be annualized around 12% return a year. So not stellar, but decent. Now, most option sellers will not do it with a cash secured put, right? They're going to use margin or leverage. And so if you happen to use a leverage account, which is what most of those insurance salesmen are using, they only need to put up for this particular trade $2,300 in cash to secure the trade, but they still collect that $130. So here you can see the return on capital, if you're doing it in a margined account, is $130 out of $2,300, which is a 5.7% return for 1 month. And what I want to call out here, what we want to get across is each of us had a thesis. Each of us made this trade, and neither one of us really lost or won, right? I mean, we all had our own idea and our own outcomes, and we were okay with either of those outcomes. So it's not a I won, Viper lost. He still has his shares. He's still in the position he wants to be in. He protected his downside. He's happy about it. I either got the shares that I was okay with down there at that price for a discount and collected additional premium to do it, or it didn't pan out and I got a nice consolation prize of $130.
Yeah. And additionally, for me, protecting the downside and whatnot, was the insurance policy worth buying? I mean, that's the age old question of any insurance policy, but thinking through the logic of everything I just laid out, remember, this is on a drop of 25%. This is on a dip from an all-time high of $311. So this insurance policy, as is laid out, on the slide, that, it takes me from a cost basis of $130 to $130. And, for somebody who's long on a position, you should be expecting to be a lot longer than just $1.30. And so Therefore, along the lines of my thesis, it says that I am expecting this to go much further than 130, 130. So it's absolutely worth the insurance, because what I don't want is to get into a deep underwater scenario. So right out of the gate, I can assess what my total loss scenario is. And now I can be like, you know what, that's fine. No matter what happens, I can accept losing this much and no more. And I can also accept paying this much and recovering it for the insurance policy, and off we go.
That's exactly it. And it's these mechanics that I think sometimes people don't fully grasp or get confused when they see the numbers. And that the way to think of this is a put option gives the buyer the right to put the shares to the seller at the strike price before expiration of his choosing. A call is the exact opposite. It gives the buyer the right to call away shares from the seller at a particular price. And if you think about this stuff and what they actually mean in the market, when you're doing options contract, it's not like shares where shares, there's a limited number of shares out there. As long as there's somebody to write that option contract, someone will write it. And as long as there's someone there to consume it, someone will consume it. It's not like the other things out there.
And the last thing that we could probably, if somebody wants us to dive deeper into it, it would be worth another segment. But say something's changed, something's come up, something dramatic has happened to one of Sprocket's other positions, and now we're approaching the way down scenario, where he's going to get these shares, and now for whatever reason he's not ready for it. That's where we can get into rolling the option to a future month where nothing changes for me, but for Sprocket, he can actually push that obligation out to further months should there be some reason that comes up for that.
We can circle back on that in a future rundown of this, but it's kind of funny because it's an option, and very appropriately, it will give you, the holder, a lot of options. It gives you flexibility. It gives you decisions. And really, when you understand what they are, it really kind of opens up different paths for how you do your investing, how you do your protection, things like that. Viper, I think this week you also did a little bit of insurance writing yourself in the futures market. Man, the Russell is just at a crazy, crazy high volatility. And what happened with that for you?
There were two things. I think we covered previously that that was my very first futures index options play. So I had an opportunity to get out dead even. I said, that's it, tapping out. Let's do it. Then it kept dropping. And then we seemed to have found a bottom. And so I kind of revisited the idea. I was like, wait a second. The mechanics haven't changed. In fact, they've gotten even juicier because it continued to plummet down. So if we look at the chart, previously when we talked about this, I believe there was this bounce here, this wick. I think it was somewhere around here that I closed out, broke even, said I can't do this. Then we got further down pressure, and I believe it was after this big dip right here. As you may or may not recall, the original contract was for the 1970 level, which is just below this yellow line here. So you can see lots of emotional stress because it actually pushes below that 1970. Even though, like I said earlier, even though you have to enter these plays, accepting the risk that you're taking on doesn't really make it any less emotional, as Sprocket can attest when this pushes down below that level that you sold at. However, after this big crush down here, we got a really nice bounce. And in my mind, what I'm also noticing is that this was yet another big bounce off of a similar level that we see back here. We go up, we get a big push down, and yet we kind of hold a little bit. So it was on this next dip down. This volatility is even higher now. It was now around 40%, I think. I want back in. I still think there's got to be a bottom or at least a little stability. That's just generally how these indexes, as an average of a whole bunch of other companies, tend to work. I now sold the 1725. It's sitting near 1970, and I'm about to enter again. So I was like, well, shoot. I mean, now I'm happy to, like, let's go down to 1725. Don't like the word safe, but more probable level of support, because this was an actual resistance before the pandemic started, before we got the big dip here. So I'm really, really liking the 1725. If it was profitable enough, I mean, I would have originally sold the 1725. So I sold that one for $27.30. Which worked out, I forget what the math worked out to be on that. But now if we zoom back in, I sold that. And as you can see, I didn't quite get the bottom, but that's okay. That's how things go. We pushed down, I was underwater a bit as it went down here. Then we got a good bounce back, and then we got a big bounce up. And after this big bounce up, I was monitoring it. And I was like, you know what? I'm at about 40-ish%, I believe. When things flattened out, I decided to buy that back. Because remember, this started by me selling the put. So to close it out, I buy it back from somebody else who the market has determined is selling it to me at a reduced rate from what I originally sold it at. And what I thought was kind of neat, the reason I sold it is because emotions, man, emotions. We had this nice little flattening here. We got a little bit up. And then over the course of 45 minutes, we had this big candle down. And I was like, you know what? This feels like maybe we're doing a little bit of a retest. Maybe we're retracing a little bit. So I'm good. I'm up nicely. Let's just wrap this up. And now instead of going home with nothing, now I'm going home with profit. Never complain about a day of profit. And sure enough, right after I sold it, just because that's how things go, it was like, oh, no, I'm not done. And got a big bounce up and then wiggled its way up even further. But what I thought was interesting was this was a fairly random place that I sold, but it's almost like they knew I sold there, and it came down and like it's getting support off this random line that I drew because that's where I bought it back. But that is to say, it has come back down. And lastly, because it's worth always driving the point home, had I waited, I guarantee you, we could actually look at the options chain, but I guarantee you, had I waited, even though it's at the exact same price, 2013, that I bought it back before, there would be more profits if I had waited, even though it's the same exact price, because we have theta decay, which always works in your favor. But no regrets. A 40% profit on the initial capital that I collected. That's fine by me. I feel like you had a bit of a different story, but how are you feeling on the RTY here?
Well, I'm still in RTY. I haven't thrown in the towel quite yet. I almost did on that rally up there that you, just after you bought it back. I made it up into the 20-25% profit range, but I'm still holding my RTY. I still got a little more theta to burn off of it. I want to see a little more volatility contraction. I'm still in a position I can roll it if needed. So we'll see how it goes. But still riding that one out. I was able to close out a similar strategy that I had in the S&P futures, the ES futures. I closed my trade back for about a 65% profit on what I sold it for. The difference between the two is volatility contraction. The Russell's volatility remains still slightly elevated, whereas the S&P volatility has really collapsed in the past few trading days. And that volatility collapse drives option prices way, way down. So you can buy them back at good discount prices. One thing to note here, if you think about this stuff where we're showing volatility contraction and prices and things like that, keep in mind, let's go back to that insurance policy. Insurance is always the most expensive when things are the riskiest, or statistically, teenage drivers are the most expensive drivers to insure. And, houses in a floodplain or in a hurricane path are the most expensive to insure. And so when the weather in the market becomes very negative, very severe, very volatile, and everybody wants insurance, guess what? Insurance premiums go up. And that's really one of the core tenets of selling options is you go out there and you sell premium when it is the richest. Yes, it is the most volatile, but as with most things, they are always overstated in the extremes. So, prices, when they go high, they go super high before they start cooling down. When they go low, they go super low. Everything has a tendency to over exaggerate. And if you watch that volatility and you sell that volatility when it is exaggerated from what it normally is, you have an extremely high probability of a reversion to the mean. And when you're selling options, you're collecting money when that volatility contracts. And as time passes, that theta decays, because remember, the value of those options must be zero at the time of expiration. And so they slowly decay away in time. And these are mechanics to be aware of, whether or not you're buying them or selling them. Just understand that's what's happening to the pricing model. That's what's happening in the market.
Yeah. I mean, that volatility increases the premium so much because, to make sure we keep personalizing the mechanics of what's happening, it's a bunch of people who didn't buy insurance who are freaking out because they're like, oh, I'm losing, I'm going to get buried on this dip. Like, it's going so low. I need to, not put a stop loss, everything I talked about before. I'm not going to put a stop loss, but I need a known stop. And so that volatility is a bunch of people rushing out going, I got to fix this. I got to put some insurance on the table. And that's where the premium comes in. And it's really not a bad gig if you can responsibly read the chart and understand what's happening and understand the risks at play, to be on the sell side, and instead of rushing to get insurance.
Well, that brings us to the end of this week's episode. Hopefully you learned a little bit about what an option actually is from our example of PayPal, where I insured Viper's purchase of his PayPal, 100 shares of PayPal. It is a very lucrative, very profitable, very sustainable model. It is one of the core tenets of my investing strategy. Of course, I diversify in my strategies, but it is the one that I love the most, is to sell that insurance out there in the market. So volatility is still pretty wild out there in the market. There's still a lot of uncertainty. There's a lot of opportunity out there. So good luck, happy trading, and remember, think outside the block.